Good afternoon. This is Molly Zimmerman, and I'm happy to welcome you here today to a webcast given by Christopher Bonner. This is presented to you from the New York State Science and Technology Law Center at the Syracuse University College of Law and their Technology Commercialization Law Program. So that's a lot of phrases, and thank you very much for being here. Christopher Bonner is a business lawyer counseling clients on corporate regulation and disclosure matters. He works extensively with the securities laws governing the offer and sale of investments. His clients include entrepreneurs, investors, and broker-dealers, among others. Mr. Bonner co-authors the annual update on business associations, which is published by the Syracuse Law Review, and covers the latest developments in New York corporate, partnership, and limited liability company law. Mr. Bonner is a graduate of the Harvard Law School, 1980, and Williams College. He's practiced with Barclay Damon and its predecessor firm, Hiscock & Barclay, since 1987. Mr. Bonner, thank you so much for being here. If anyone has any questions during the presentation, please feel free to type them in, and we will ask them of Mr. Bonner as he goes.
Thank you, Molly. It's always a pleasure to come meet and talk at the New York State Science and Technology Law Center. It might be helpful to state the entire title as an acronym, NYS, STLC, or NYSTILC as it appears when it's spelled out. A little bit about my background. I do business and securities law, just like Molly was saying. And for quite a few lawyers, startups are really interesting. And of course, technology transfer, which NYSTILC has as its mission, encompasses quite a few things beyond just startups. But startups are really interesting, and they are a way that technology can move out of the university setting into the broader commercialization. And so it is with regard to startups that I'm going to talk about crowdfunding. Now, what I will want to say about crowdfunding and securities offerings is that to raise money, you can now post your securities offering, your fundraising for investment purposes over the internet. I'll also want to say that in order to do that, you'll need to write a good business plan. Now, if you didn't know that already, I want to emphasize that particular point. And one interesting aspect of crowdfunding, which has yet to be proven, this is part of the cutting edge, I would say, of investment and fundraising, is that crowdfunding will replace a traditional model of stock sales, which depends upon a salesperson contacting an individual customer and suggesting a particular investment. It will replace that with what is much more like window shopping, where the investor looks at a wide variety of different investments and picks one. Now, when I say it replaces that in concept. Whether it will actually catch on as a way of selling investments has yet to be seen. So we, the people who are interested in it, will be looking at that to see what develops. Now, the specific incitement or impetus for this particular presentation came from the effectiveness of crowdfunding rules that were published by the United States Securities and Exchange Commission. And what these regulations do is provide that a startup can now advertise across the entire country for investors. And for the folk who don't know what crowdfunding is, it's started out as a way to fund particular projects or artistic endeavors by asking lots of folk out there, hundreds, maybe thousands, as many people as you could get, over the internet to make a contribution of a small amount of money for your particular endeavor. And the idea would be that, you know, you're asking for only a little bit of money, and so if somebody likes it, they'd be willing to just reach into their pocket and, metaphorically speaking, and hand over $5 or $10. And if you had enough people do that, why, you'd be able to fund your concert or publish your comic book or do whatever it was that you were hoping to accomplish. Now, in return, the person soliciting the contributions might send something back. You know, for a $20 contribution, you get a ticket to the concert. For a lower contribution, you might get something else. In each case, what you'd get back would legally be a good or a service. What it would not be would be a promise to pay you back money with a return on your investment. Now, for funding a startup, that's the big difference. For funding a startup, unless you're saying, look, will you please contribute to my business, and I'll make all the profit, and maybe I'll do some good for the world, but at least I'll make all the profit. Well, you know, who's going to send in $5 or $10 for that? Well, maybe enough people, and I know I've seen people try that, but more significantly, that really requires the company to tell its audience, the people who it's asking to contribute, it has to tell them, well, because this is a business venture, if you give me money, I will give you your money back plus a return. Now, the return, the promise of an investment return, is what in most cases produces the legal item, the legal thing called a security. And I know the word security is used far too much in law because it could mean a whole ton of different things. But here, I want it to specify it will mean an investment contract. And an investment contract under federal and state law is what's governed by what we call securities regulation. And an offering of securities legally must either be registered with the SEC or it must be exempt from registration. And there are more than a dozen separate different exemptions from registration, and they are interesting to keep track of, and it's easy for someone to get lost in all the minutiae of all of the different exemptions. However, I'm going to focus on just one of them, and that's the crowdfunding exemption, which the SEC finalized the rules for, effective May 16. Now, before the crowdfunding exemption, there were only a couple of ways where legally you could do crowdfunding for Main Street, for the generalized individual investor. One way was to do a Regulation A offering. That's still available in a modified form. But that required the filing of a registration statement with a state securities regulator or with the SEC, and was basically a registration in miniature. Now, for people unfamiliar with the process, the registration is usually quite expensive because in addition to taking paper or filing online, you can also have a computer file that you send by over the internet. You also have to have lawyers and accountants. And I know from experience that the lawyers' fees have been reduced so that they are a relatively small fraction of the total offering costs. But you also need to have your accountants involved, and usually they will have to audit the financial statements. And the bigger the offering, the more that's going to cost. And practically speaking, the mini registrations were not really effective as a way of raising capital for a startup business. Now, after the recession started in 2008, there were several business trends that brought people to think about having crowdfunding as a potential for a way to fund the startup business. One of the more interesting and perhaps more important business trends was that if you were a small investor, someone who was just an ordinary person with some money to invest but not a lot, the opportunity to get in on the ground floor of a highly successful business had gone away pretty much. And that was because after Sarbanes-Oxley, the Sarbanes-Oxley of 2002, was passed by Congress to reduce or prevent a number of financial abuses. After that act was passed, the increased regulatory burden on companies whose stock was publicly available for small investors became sufficiently high that being a public company was not nearly as attractive as once it had been. And there even is now, there arose then and is now, a tendency for those companies that are publicly available to be essentially mature companies that have done most of their growing and are now cashing out, so that the stock that's available in them on the stock exchange, and which is available through your broker on the public market, or which is being sold to most mutual funds. This particular stock is essentially, in terms of growth, slow growth or stagnant. For fast, explosive startup growth, companies basically were not making their securities available to the small investor. That was one problem. The next problem was that after the recession started, new business starts weren't happening. For the most part, any new businesses that did get organized and become active commercial enterprises were launched only in a few areas in the country. And everybody knows about Silicon Valley, and New York City had quite a few startups itself. There were areas in Texas, Austin, Houston in particular, where lots of startups were formed and became busy. And there were other urban centers that had some too, and of course, plenty of cities all across the country encourage startups to with more or less success. Syracuse certainly does. But except for a very few places, new businesses just weren't being started. And a perception was that one of the reasons was that they couldn't get money. And part of that was caused by the absence of traditional bank financing. After the recession started, the Congress and the regulatory agencies were told that banks had been far too they hadn't been nearly cautious enough in making their loans, so that afterwards, obtaining a loan for a new venture was very problematic. Then, the use of crowdfunding for artistic events and artistic projects was proving to be very successful. About 2009 was when Kickstarter and Indiegogo, who are two of the more famous crowdfunding platforms, got started, and they were highly successful. And so a few people said, well, you know, because our economy is doing badly, why don't we use crowdfunding as a means for starting a new business? And that's how crowdfunding got incorporated into the Jobs Act of 2012 with the Jobs Act called the Jumpstart Our Business Startup Acts of 2012. Has a somewhat redundant title, but that does describe what the Jobs Act hoped to accomplish. Okay. Now, the Jobs Act includes elaborate instructions to the SEC about what kind of rules it needs to adopt to allow crowdfunding. And those rules cover disclosure. They cover the establishment of so-called funding portals, which are very important for the crowdfunding structure. And they established investment limits. They didn't want individual investors to put their entire life savings into risky startups, although they did want to allow someone to take a flyer if they wanted to. Okay. The process took a while at the SEC. The requirements of Congress are elaborate, and the SEC was late in offering draft regulations for public comment. As you've seen in many other instances, under the Administrative Procedure Act, a federal agency must at the very least offer a proposed regulation for public comment and take those comments into account before the regulations become law, before they're adopted in their final form. And so that's what the SEC did with its notice and comment rulemaking. The SEC drafted the regulations and offered them to the public for comment. It got reactions from both sides, so to speak. I'll get into that. I'll get into taking advantage in a little bit. The commenters had two camps. One camp said that the SEC's regulations were too complicated. Crowdfunding was supposed to be easy. You're supposed to be able to just say, hey, people out there, I have a startup in my garage that's going to make everybody rich, and it will be the next big thing. So why don't you all send me $10 and I will give you 0.0000, et cetera, 1% of my company. It's supposed to be easy. Well, under the regulations, it's when you offer your stock, you have to offer it, although electronically, the same way that any other new startup company would, which is to describe your business and, tell people how much they're getting and tell people, the risks and rewards that they're facing. And so a lot of folk thought that the SEC's regulations were just too complicated and would make it much too burdensome. On the other hand, there were both state securities regulators. As we know, each state has its own securities regulator, as well as their existing the SEC. So the state securities regulators and various folk who were looking after the interests of investors were saying, look, it's going to be like wild and uncontrolled out there. You're allowing practically anybody to go to mom and pop don't necessarily know that, you try to tell them, but they don't necessarily catch on that if it sounds too good to be true, then it probably is. So we're worried about investors losing all their money. These two camps argued it out in front of the SEC, and that debate meant that the SEC had to take a lot of time to consider the comments, which it did, and to reach a conclusion about what the final rules were going to look like. And the final rules were pretty much like the rules as proposed, and importantly, the final rules were as required by Congress. The structure, which I'm going to describe, was mandated by Congress. The SEC doesn't object to the structure. The SEC likes the structure, but the complexities have their origin in Congress trying to reach a synthesis of investor protection on the one hand and ease of attracting investments on the other. Now, how it was set up. From the company's perspective, an issuer of securities, and now the securities can be stock, it can be bonds, it can be convertible notes, it can be LLC membership interests. It's any kind of investment contract. The issuer of securities may offer and sell up to $1 million in any 12-month period. So you look at the particular date on which you're offering the securities, you look back 12 months, how much have you offered up to that time? If you are using the crowdfunding exemption, you can only offer up to $1 million. Now, an important point to note is that crowdfunding that I'm describing is just one of roughly a dozen different exemptions available, and you can think of the exemptions as pigeonholes, where you can have so much money in pigeonhole A and so much money in pigeonhole B and more in pigeonhole C. And under most circumstances, you can use any number of pigeonholes at the same time. Now, having said that, that's far from a universal rule that you can always rely on. But it's important to note here that this is one exemption I'm talking about. And if you're making an offering of securities legally and you fail to come entirely within one exemption, you might actually come within another exemption, so your offering isn't necessarily illegal. An important point for the lawyers. For the entrepreneurs, the thing to keep in mind is $1 million if you use this one. Okay. Funding portal. You have to use a funding portal. And I'll describe what a funding portal is, but basically it is a company that acts as an offering platform where you post your offering and they advertise it over the internet. Then the next thing the company has to do is put together an offering statement, which discloses important and relevant information. Now, disclosure is one of the most important legal concepts involved with securities offerings. The concept has two components. Originally, back in the day, at the time that the securities laws were first adopted, every offering had a fairly elaborate business plan or prospectus that accompanied it. It just went without saying that if you were going to try to talk anybody into giving up their money for investing in your company, that you would have to present a plan and tell them how they were going to make a lot of money. So originally, disclosure meant, and don't conceal anything from them. Don't hide anything that they might reasonably want to know. For instance, if in the first 2 years of your operations you made a profit, and then in the last 8 years you've had a loss, but on the average you've had a profit, you do not tell them only that you've averaged a profit in your last 10 years. True statement. But if your last 8 years have been losses that have been counterbalanced by 2 really good years at the beginning, and you haven't told them that, why, effectively you've told them a half-truth or a misleading statement. That's a problem. That is bad disclosure. It's illegal. So you have to be sure that you tell them everything that a reasonable investor wants to know. That was the original idea. It was, don't hide anything. Since that time, disclosure has come to mean more just because as time went by, it became apparent that investors were willing to give up their money with a lot less paper presented to them than you would have thought. So that the prospectus as such would become shorter and shorter, practically non-existent. But someone would say, look, just sign here and give me a check, and you have blank % of my company, which is going to make us all rich. So disclosure has come to have a positive or an affirmative duty as well to describe the very basics of the business, and there's a lot. The securities law concept is that you don't really have the right to take money from a stranger without telling them what you're doing with it. And essentially, you have to know what you're doing, or at least think you know what you're doing, and present what you think you know you're doing to your stranger before the stranger can legally invest in your company. Now, the onus or the legal liability is all on the offeror, on the company, the startup company, and its promoters. The investor is only exposed to the extent that the investor is going to lose money. So the offeror now has to put together essentially a good business plan. And as many of the people who work with the Science and Technology Law Center know, putting together a good business plan is tough. You have an awful lot of work to do. You have to describe your product. You have to describe your market. You have to describe what you think your costs are going to be. You have to describe what your competition is going to be, and it requires much thought, as well as a lot of careful writing and careful presentation. And you also have to have numbers. You always have to be able to present numbers, and of course, you have to be able to have projections. Now, projections, of course, are difficult. It's always a guess about what your costs are going to be. It's always a guess about how big your market is, or how much your potential customers are going to be willing to pay. It's always a guess. But unless you have some reason for thinking that you'll be able to make something or sell something at a profit, it's pointless to try to proceed as a startup business. So, on those general principles, the startup regulations of the SEC, the crowdfunding regulation, contains a number of items which you'd kind of expect you should tell your investors. One important amount which applies to offerings as such, in contrast to a business plan in general, is the target offering amount. And here, if an investor is going to put money into an offering, it's like, well, now wait a minute, the investor says, if the investor is thinking about it, the investor will say, look, am I putting in the first dollar or am I putting in the last dollar for your offering? Because if I'm putting in the first dollar, I'm taking more risk, and shouldn't I be getting a better return? And to deal with that issue, startup offerings for as long as anyone can remember, as long as there have been startup offerings, have had minimums and potential maximums. So they'd say, look, unless we get enough money to launch our startup, and for our purposes, we can think of it as maybe 200,000, 500,000, $1 million, a number of that magnitude, because that's the size of the exemption we're talking about. Unless I get that minimum, I'm not going to take anybody's money. I may have your check, but the proceeds of your check are going to sit in a bank account in escrow until I get the minimum. And once I get the minimum, of course, the money's mine and I'm going to spend it on the business. But until I get that minimum, you're going to get your money back if I can't close. So the first dollar does not have any greater risk than the last dollar. That's crucial. And that is essential in a crowdfunding offering because the regulation specifically states you will describe what your target offering amount is, you'll describe what your minimum is, and you'll put a deadline on it. Say if we don't get this much money by a particular time, we're going to shut down the offering and return everybody's money. Okay. The regulation requires financial statements. And one of the few points, it seems to me, where the criticism both for and against the SEC, depending upon what side of that argument you're on, carries some weight, is regarding the involvement of accountants. The SEC said that for offerings of less than $100,000, you have to have financial statements, but you don't need the involvement of any third-party accountants to say whether those financial statements are reasonable, whether they meet auditing standards or anything else. When the offering is between $100,000 and $500,000, the financial statements must be reviewed. And a review is a fairly low-level examination of financial statements, but nonetheless, it does expose the accountants to some potential liability, and quite properly it costs some money, and the accountants quite properly attempt to reduce their potential liability by undertaking a series of procedures to make sure that basically that the financial statements look right. What they don't do in the review is actually look underneath the financial statements, and if you say you have so much of assets or you have only so much of liabilities, they don't actually go and check whether your asset is actually there or whether the liabilities that you say you have are precisely what you say. They take your word for it at the review. The audit is where they check the background. And you don't need to have an audit for a crowdfunded offering unless it is the second or later crowdfunded offering the company's doing, and the offering exceeds $500,000. Now, along with full disclosure, you also need to describe the business experience of the directors and officers. You need to disclose the name of everybody who owns 20% or more of the voting rights in the company. You have to describe risk factors, things that make this investment speculative or risky. And the regulations also require, just like everything else in securities law, a disclosure of everything else that a reasonable investor might think important in making the investment. Now, this standard is, for the lawyers, an objective standard. It's what a reasonable investor would want to know. And what the reasonable investor would want to know is not necessarily a make or break fact. It is something that the investor will take into account among all the other factors in deciding whether to go or no go into the offering. One of the things that I've noticed, practically speaking, that a court will consider a material, regardless of whether the promoters think it's material, is a past felony criminal proceeding or a past bankruptcy. Now, bankruptcy seems hardly criminal to me, but nonetheless, a past bankruptcy will be considered material, even if it happened significantly long ago in the past. This is an issue with many people because sometimes a director or officer might have had a company or been an officer or on the board of a company that went bankrupt a long time ago, and they say, look, that's not really relevant, different business, I wasn't in charge of it. And there I say, well, now the problem is that if the investment goes bad, the investor is going to complain and say you didn't tell them about this, and if the investor had known about it, the investor wouldn't have invested, and then you have the problem of trying to convince a finder of fact, a court or a jury, that the specific fact that you did not disclose really wasn't material, was not something that a reasonable investor would want to know. And that case is going to have settlement value, by which we understand that in order to make it go away, you're going to have to pay some money. Okay. Now, once the company has a crowdfunding offering, the company is required to file an annual report with the SEC and report to the public through the company's website. And that obligation goes away if the number of shareholders of the company diminishes below a certain threshold. Now, one of the questions that always arises is about advertising. I'm the company and I'm offering securities. How do I advertise? Well, basically the funding portal is going to do all the work. But short of that, you're allowed to put a statement out there, on the internet, that you're conducting a securities offering. You can direct the investor to the funding platform. You can describe what kind of securities you're offering, such as I'm offering so many thousand shares of stock at $blank per share, and the closing date is going to be a particular date. If you want more information, go to the funding portal. And what you cannot do for a crowdfund offering this is one of the many investor protections that show up in the crowdfunding regulation, is you have no specific business plan. What does that mean? Well, it says, well, basically, we think that the such and such business is the coming thing, so what we're going to do is we're going to raise a lot of money and go look for a company to buy that's in that particular line of business. That is quite a commonly seen business plan that is referred to by the SEC as one with no specific business plan or a plan to engage in an acquisition with an unidentified company. If that is the business plan, you can't use this securities law exemption. No, crowdfunding is out. Now, the funding portal. The funding portal is an essential component for investor protection that the SEC, at the requirement of Congress, put into the crowdfunding regulation. And the funding portal is designed essentially to be a platform so that the investor who wants to invest in crowdfund offerings goes to the funding portal and shops, looks at the various offerings available, and picks the offerings that the investor likes. The investor looks at them some more, but the actual investment itself does not occur through the funding portal, strictly speaking. In fact, not so strictly speaking. The reason why is that the time when the money changes hands is quite risky. We tend not to think of it as risky simply because up until now, the point at which the money is handed over to somebody in return for the security is highly regulated. These days, we're in our country, if you're going to buy a security, that's on the stock market, you do it through a highly regulated broker-dealer who has lots of rules describing how they take cash, where they keep the cash, how they deliver the investment that you've purchased. And generally speaking, that's safe, generally speaking. And that's why we're not used to thinking about the concept of somebody who's going to take all the money, promise you a bunch of stock in return, and maybe you get your stock and maybe you don't, but whoever took the money disappears. Or, somebody says they're selling stock for a startup. They're not really. They've just counterfeited all these securities, and they sell you all these counterfeit securities, take your money and run. That is why the Congress was careful to state that the funding portal, although they can do a lot, there are some things that they cannot do. Now, it happens that you don't have to use a funding portal if you use a full service broker-dealer. The funding portal is an intermediate category of entity. It's between, a completely unregulated, group of people and a fully regulated broker-dealer. It's in between, and the idea is to facilitate crowdfunding. So the funding portal does two really important things. First, it lists all of the securities that are being offered for sale. The second thing it does is check some of the very important, according to Congress, investor protections. The investor protections that it is supposed to take care of include both an attempt at investor education. The funding portal is required to send material to each investor about crowdfunding and about investments, and to be satisfied that the investor understands. The second thing that the portal is supposed to do is supposed to inform the investor and get a promise from the investor about the limits of the dollar amounts that the investor is allowed to do for crowdfunding as a whole. I'll get to those, but there are dollar limits on how much an investor, over on the investor side, the investor is allowed to risk in crowdfunding. Now, it's important that the funding portal be financially independent of the company whose securities it offers. Now, practically, this won't be too difficult because the portal itself is usually an entirely different business. A portal is in technological terms quite interesting because it essentially automates, in order to make it inexpensive, a fairly elaborate process of checking out each investor, of posting, offering literature on a website for each of the companies, and for making sure that each of the I's are dotted and T's are crossed in the offering process. That company is essentially different from what most every other startup is doing. However, it's still the rule that you can't have a financial interest, if you're a funding portal, in the company that you're offering, or any of the companies that you're offering. You are, however, allowed to take a commission. That's important. So you can say, we own no stock in any of the companies we're offering, although we are taking a commission payable in stock. You can do that. To be a funding portal, you also need to pay application and maintenance fees with the regulatory arm of the National Association of Securities Dealers. Congress said, okay, the National Association of Securities Dealers, in addition to regulating brokers and dealers, full broker dealers, will also get to regulate funding portals. And so FINRA, the regulatory arm, has published regulations about how a funding portal gets licensed. Now, for the investors themselves, there are some important limits. I have seen at least one commentator in the general public complain that it's really not fair to various folk today that they cannot invest in really adventurous startups the way that our preceding generations could. So, well, now they can. Of course, finding the right startup out of thousands is a real challenge. But nonetheless, Congress said, let's not allow people to get carried away here. So they put two levels of limits on how much an investor can invest. The first or lower level is those whose annual income or net worth is less than $100,000. So if your annual income is less than $100,000 per year, or your net worth is less than $100,000, the maximum that you are supposed to invest in crowdfunding offerings is, well, you can invest up to $2,000 in any 12-month period. But otherwise, you're capped at 5% of your net worth or 5% of your annual income. And it's a little confusing to work through the formula to see what the cap is. But the funding portal is supposed to walk you through the process, and it can take your word for it. The funding portal can. They're allowed to take your word for it that you are within the cap. The higher level is annual income and net worth are both $100,000 or higher. And then you're allowed to invest according to another formula that caps out at $100,000. Now, this is all of the crowdfunding offerings that a particular individual is doing. So you can be on Funding Portal A looking at some of their offerings. You can look at Funding Portal B looking at some of their offerings, and as many as you want. The Funding Portal A, it has to take your word for it, if you're the investor, that you're not also investing over on Funding Portal B. Or you tell them how much you're doing on Funding Portal B. But you can lie to them. And as far as the funding portals are concerned, they have no obligation to dig deep or to try to get any information from you, the investor, about whether you're telling them the truth or not. And if you're the investor, there are no legal penalties for breaking this rule. So let's suppose my annual income or net worth is less than $100,000, but nonetheless I take an inheritance or something and invest $50,000 in excess of my limit on crowdfunding portals and have more than I'm allowed. There are no adverse legal consequences. Of course, it's a very foolish thing to do, but nonetheless, this rule is designed to protect the investors and not to punish them. Okay. Now, the actual framework has quite a lot of context and quite a lot of fine points that I have skipped over here for purposes of trying to present a relatively even overview. There are several thoughts for the future that these raise. I know that we're all supposed to get excited about the next big thing. This is the latest thing. Conceptually, it is quite exciting. I know I'm not very good at actually conveying excitement to you, but this is fair to be excited about, definitely in concept, because it is presenting a drastically different model of securities investment than we've had. There is a sort of a cynical statement out there. You may have come across it. They say, stocks are not bought, they're sold. You say, well, what does that mean? Well, that means that it's not as if you have somebody banging on the door saying, sell me your stock. Rather, what happens in the securities markets is that a broker calls somebody up and says, you need to look at this particular company because the stock is really moving. This is going to be a really good investment. And that's not 100% true. That's 99.5% true that almost all security sales that are made because a particular investment professional is recommending a particular security to be bought. And this is easy for me to understand, just as a matter of arithmetic. You go look at, I want to make an investment. Well, what do I want to invest in? There are like dozens of different categories of investments, of investment kinds. In each of those kinds, there's a whole spectrum of risk and reward. Within each kind, there are thousands of issues, and each one is different. Now, if I'm looking, say, at buying the stock of a public company, which is what? Large cap growth. That is actually one where I will probably have the fewest number of possible selections, but I'll have dozens, if not hundreds, to choose from. Okay. So how do I know whether I want this one or this one or this one or this one? Well, I end up calling up a broker. I guess that's part of the stock being bought, but it's the broker who takes out of all those categories one that's appropriate for me to buy. Okay. In that sense, stocks are not bought, they are sold. Big difference under the crowdfunding regulation. Under the crowdfunding regulation, I can hire a broker to do that if I want to. But then I have to find the broker, I have to say the broker, and I'll pay you to do that. This is not a situation where the company or the platform can do that. Instead, this is a situation where all that the company and the platform can do is post the information about the offering. It's up to the universe of investors, potentially dozens of millions, to go surfing across funding portal platforms to find one they like. Nobody knows how that's going to work out. How do I know they're going to like my platform? I pick a particular platform which looks good. And in fact, there are hundreds of platforms available now. So you have to find a platform, you like. Then you get on the platform, you see lots of great-looking investments. How do you pick one? Now, it could very well be that this will work out because not only are there millions of potential investors, many of those investors do like doing the research. They like checking things out. Now, will this end up being a situation where you have internet chat rooms for startups where you'll secretly plant somebody to lie to potential investors about your offering? Who knows? Nobody knows. It promises to become quite interesting, though. And most significantly, this is now another opportunity, another way in which companies can look for funding. Now, at this point, if I have left out a particular kind of thing that anybody's interested in, I'd love to address it. Questions? Yes, Molly.
I've seen a number of opportunities, not necessarily advertised, but kicked off at an event or something. Could you talk a little bit about that as a strategy to publicize the investment. And also, I may have missed this, but when someone does go on the website, will the business plan that you referenced be there for them to research?
The easy answer is that when you go on to the website, the plan or the concept is that the business plan will be there for you to research. Now, because the offeror is the king of the offer, so to speak, they can present the offer however they want it. They can, if they desire, say, no, you'll have to talk to us first, and then we'll send you the business plan. But it is the case that they have to give you the business plan legally before they take your money. Okay, that's the second question. Now, to refer to the earlier question about the offers and opportunities. Yes, that can be done. Now, I can give some backstory about the concept of the tombstone advertising. For folk who remember what advertising of securities looked like before 1980, the securities laws then stated that there was only a limited amount of advertising you could do in the newspaper about a securities offering because the Securities and Exchange Commission was basically keeping it buttoned down. And so all you could do was after an offering had closed, you could print a description that had about 3 line items in it. It had the name of the offeror, the amount of money, the type of security, and a 4th line item, which was absolutely crucial, the name of the investment bank that had spent all the money advertising and closing the offering. So that would be presented in a very blank, blasé, tabular format, and it was also presented after the offering had closed. So it looked like a tombstone. The offering was dead. You couldn't participate in it anymore, hence it was called a tombstone advertising. That's allowed. If you're going to use this exemption, the crowdfunding exemption, the offeror itself has to limit its advertising to something like a tombstone. Now, having said that, it doesn't have to feel like a tombstone. When you say, presenting an opportunity, exactly so, you can call it that. You say, here is an opportunity to invest. My company is offering blank thousand shares or blank thousand units or blank thousand whatever at so much per investment in an offering, and we plan to close it by a particular date. Yeah.
Thank you. There's another question here, and if the sender would not mind, I can't read the whole thing, but I'm going to read what I can read. I'm trying to summarize, and in doing so, have questions embedded.
Yes.
For crowdfunding, number 1, hire an attorney or an accountant. Number 2, must complete a business plan, wondering if needed for the arts. 3, be willing to pay a commission to Portal. And then 4, unsure of how funds, and if the writer would write back, I can't read the rest of that.
Okay, well, let's start with the first question. The first question was the necessity for an attorney or an accountant. Okay, if the offering is more than $100,000, the rule requires the presence of an accountant. Is it a good idea to have an attorney involved? Well, obviously, I think so. It's like, if a man walks into a barber and asks if he needs a haircut, what answer is he going to get? So, an attorney can definitely help. It is not legally required to have an attorney, and the heavy lifting, so to speak, the hard thinking about the business plan and what goes in it and what should be covered. The hard work is done by the entrepreneur, the startup the startup company person who's putting together the company and the offering. Having an attorney, you probably do need an attorney for addressing the question of what's material, because the concept of what's material and what needs to be disclosed is not obvious. You need to start thinking a little bit more about the investor's perspective and what's out there that causes investors to have a right to sue you if something goes wrong. And the example of things in the past about the officers and directors, that matters. Or things in the past about maybe one of your major holders. You may, for instance, be offering 30,000 shares in a 100,000 share company, and maybe 10,000 of the shares that are not the subject of the offering are owned by somebody who has a past. Will you necessarily think about that and talk about it and disclose it? Well, an attorney should be helpful in telling you what you need to think about for disclosure purposes. So recommended, of course. Mandatory, no. Okay, that was the first question.
Yes. Why don't I read it again? Because
Yeah. Mm-hmm.
Okay, you addressed the first part. Number 2, must they complete a business plan, wondering if needed for the arts? And 3, be willing. Well, do you want to address that part too?
Oh, sure. Well, to start with, for the arts, in the case of an artistic project or production or concert or presentation, the first question is whether you're really offering an investment contract. If someone says, look, I need this much money in order to produce my painting or to do my sculpture or to present my musical composition or whatever, in that case, it may be that what they offer in return, if they offer anything in return, is not a so-called investment contract. That is, they're not offering, I'll pay you your money back with a profit. That's not the legal definition of an investment contract, but that's what it feels like. If you basically say, if you put your money into my project, you will get a return. You will get a positive return. That is an investment contract. A security, yes, and for a security, yes, you need a business plan. You need to tell your investor how you're going to make money with their investment. If on the other hand you say, look, I need your money to make an artistic production. Well, if you don't promise them anything back, then you don't need a business plan. Now, of course, that reminds me to say everything that I'm telling you cannot really fully satisfy the requirements of legal advice. Because if your person goes on to say, well, what I'll do is I will make a work of art. Now, of course, once I do, I'm going to try to sell it. And if I'm successfully in selling it, I will try to pay back, my backers, even with a profit. But I'm not promising them a profit because I can't promise that, anybody will want to buy. That is a standard investment. That's a security. You've basically said, I'm going to take your money, do something with it, try to make a profit from it, and share the profit with you. In that situation, yes, you need a business plan, even though it's an artistic production.
The third and fourth, be willing to pay a commission to portal. And number 4, unsure of how the funds are tracked and timed if the portal is not accomplishing this.
Yes, you're able to pay the portal a commission. The handling of the funds is really important, and I have only begun to hint at the necessities here. Essentially, it's done by either the company itself or a third party. And if it's done by the company itself, that raises a big question. The company says, well, I'm going to take your check, but how do you know that the company isn't going to start spending the money as fast as it comes in? Well, that is a question in startup securities law that's been around for as long as anybody can remember. That has to be addressed, and there are several ways of addressing it. The standard way of addressing it is by means of an escrow. That is, you get a real live bank that really agrees to be an escrow agent. And if you can do that, or you find someone who is, for whatever reason, genuinely independent and also willing to take on that risk, who will hold the cash for somebody else. So I know that
would be if it was under the certain limits, then they're not required to use.
Okay. No, the problem here is that if you're going to use this particular exemption, and in fact, it's going to happen with any startup, you say, okay, if you send in a check, we're going to essentially hold on to your cash. You need, practically speaking, you need to cash the check just to start the collection process on the check. But we will hold the cash until we achieve a threshold. Then at that point, the escrow agent pays the cash over to the company, and the company starts spending it. Am I addressing the point? Yeah. Okay.
The fourth one was just he's unsure of
okay, go ahead.
How the funds are tracked and timed if the portal is not accomplishing this.
It has to be done by the company or by a third party. I've seen at least one portal basically engages the service of a bank. It has a deal with a bank where the bank does that. And Jack, you had a question?
Yes, I did.
Sure.
Thanks. Okay. While you don't have to hire counsel,
yeah.
It sounds to me like it's a pretty good idea. And when you do hire a counsel, you would expect to pay something substantially less in legal fees than if you were doing like a private placement memo or what historically had been done before crowdfunding. Am I correct about that?
Oh, the counsel fees. No, that's a really tough one because what the counsel does with an offering generally is work on the offering document, making sure that it covers everything it needs to. And also being careful about some of its promotional language to make sure it doesn't promise more than it can deliver. And that's going to be about the same. Once you have an offering document, it's going to take a certain amount of time. Generally out there, I would say that in terms of lawyers' time, it's very difficult to take less than 30 hours of lawyers' time on an offering document. And so you multiply that by the hourly rate, and maybe you can talk your lawyer into giving you a deal or something, but that's going to be about the minimum with it because you have an offering document.
I have a quick follow-up question.
Sure.
And many startups will use money from friends and family.
Yes.
Where maybe they don't worry about Aunt Jane and suing them. Of course, we know Aunt Jane just lost her entire investment portfolio to this venture, and who knows how she feels. But
right.
Do you see crowdfunding making it friends and family perhaps a little bit safer or easier, or doesn't it really matter where you're raising your money?
Yeah, I see it as not really mattering. The thing about friends and family is that you, the startup entrepreneur, basically get much better terms because they're not going to hassle you so much over their percentage of the company. You know, they want to be part of it, but they want to support you, and they're not going to worry too much about the valuation, whether you have basically given them too little a percentage in return for their money. Their likelihood of suing you, it depends upon lots of variables, including the amount of money involved. Now, I don't see that crowdfunding is going to make it any safer. Whether or not you'll get sued for securities fraud in connection with a crowdfund offering, it's hard to say. My guess is that for the most part, well, no, I'd better not say what I was thinking, but I'll say it anyway, which is that the chances of being sued depend a lot upon the amount at stake. And under this crowdfund exemption, assuming that you're complying with the dollar limit of $1 million, whoever is going to sue the company for a securities law violation, they're not going to be able to recover very much money. That's going to matter.
There's no further questions. I want to thank you again for your presentation. It's very informative, and it will be posted to the listeners who are wondering on the nysSTLC.syr.edu website under Resources and Webcast. Thank you again.
You're very welcome. I appreciate being here.